What is going on, my friends? Ryan Williams here, back with another one, and maybe you guys have already heard the news, but Merck, a pharmaceutical company whose ticker symbol is MRK, announced at the beginning of the month that they have developed an orally ingestible antiviral pill that can reduce the risk of hospitalization or death from the COVID virus by about 50%. Now, as I'm sure you can imagine, this news sent Merck's stock price higher than Snoop Dogg on a ski lift in Colorado, and just in the last 5 days, shares of Merck climbed by over 11%. And while this is good news for Merck shareholders, this actually had a slightly negative effect on some other companies who have developed vaccines for the virus, namely Johnson & Johnson and Pfizer, which actually have been trending downwards recently anyways, along with another stock in the healthcare sector, Bristol Myers Squibb, ticker symbol BMY, which brings me to the topic of today's video. In this one, we're going to be taking a look at each of these three stocks to see just how much they have come down in share price in the last month, and we're also going to be comparing the dividend stats and the historical performance of each stock to see which ones may be the best to invest in right now. Anyway, before we get rocking and rolling, if you guys are proud shareholders of any of these three companies, Johnson & Johnson, Pfizer, or Bristol Myers Squibb, go ahead and give this video a big thumbs up. And if dividend stocks is kind of your thing, then be sure to hit that subscribe button as well, because on this channel, we strictly talk about dividend stocks, and I would love it if each and every one of you followed me along on my dividend investing journey. Anyway, thank you so much for doing that. You guys are awesome. And now, without further ado, let's get into it. All right, my friends, now kicking things off, let's start by talking about Johnson & Johnson, ticker symbol J&J, which, as you can see, just in the last month is down almost 9%, 8.83% to be exact, which is pretty extreme. The stock has really come down in share price in the last 30 days. And some of the reason is because of the news surrounding Merck's antiviral pill, and there's also some other news surrounding the healthcare sector in general. But also, as I'm sure a lot of you guys are already aware, a lot of stocks were coming down in share price in the last month. September was a really interesting month for the stock market. I don't know about you guys, but my portfolio really took a hit in the last 30 days. And Johnson & Johnson, which is a part of my portfolio, is certainly no exception to that. Anyway, moving on, if we look at the right-hand side of this screenshot here, we can see that Johnson & Johnson has a forward PE ratio of 16.54, which is really not too bad, and actually has Johnson & Johnson looking like it is within buying range. And the thing about Johnson & Johnson, guys, is it is one of the more sought-after dividend stocks. A lot of dividend investors have this in their portfolio. I think you'd be hard-pressed to find a dividend investor who does not own some Johnson & Johnson. And so with that said, if you can get Johnson & Johnson at any sort of discount, that is an opportunity that you should jump on. And it is looking like right now is a good opportunity to pick some up. Just based on how much it's dropped in the last month, you can get it at a 9% discount compared to 30 days ago. And also the PE ratio is sitting pretty low right now, so could be a good buying opportunity for this stock. And moving on, let's take a look at the dividend stats. And I think by looking at this, you guys can see why this stock is so sought after. We'll get to the forward yield and payout ratio and stuff like that in just a moment. But first, let's take a look at this dividend growth history. From looking at this screenshot, we can see that Johnson & Johnson has a dividend growth history of 59 consecutive years, which is just unreal, guys. This dividend is super reliable, guys. They've been paying it and growing it for 59 straight years, so you can rest assured that it is going to be more safe than some of the other dividend investments that you could be making, which is why a lot of people like to have this stock in their portfolio. Because of its dividend growth history, a lot of people look to it as one of the more reliable investments, and in general, a very safe bet as far as investing in dividend stocks go. But anyway, let's talk about some of the other stats. So Johnson & Johnson has a forward dividend yield of 2.66%, which is not super duper high, but it is kind of a trade-off considering we get 59 years of consecutive dividend growth. Moving on, the payout ratio is looking like it's in a pretty good spot, 43.95%, and the 5-year growth rate is actually not too bad, 5.96%. And moving on, guys, there are a couple stats that we can look at on this screenshot right here that kind of point to the reliability of the stock and the dividend. The first of which is the revenue. Now, we can see pretty much across all time periods, across year over year, 3 years, 5 year, 10 years, this company is growing in revenue, which is really good. It's still growing and expanding as a company and doing more sales than it did in previous years, pretty much consistently across time. And then the other metric we can look at is the levered free cash flow down there at the bottom, which looks not too different from the revenue, just seems to go up and up every year and outperform previous years. And this is especially important for the dividend, guys, because for those of you who don't know, free cash flow is what these companies use to pay their dividends. So if the free cash flow is growing every single year, we can probably bet that the dividend is going to continue to grow with that as well, which obviously is a good thing for us dividend investors. That's what we want to look for when implementing a dividend growth strategy, especially if if we're investing across 5, 10, 20 plus years. So I kind of touched on this a little bit earlier, guys, but I do think right now would be a good time to pick up some Johnson & Johnson. As I said, it is probably one of the less risky investments that you can make and is a great choice if you're looking for a stock that you can buy and hold forever. And like we saw earlier, right now you can get it for about 9% cheaper than you could 30 days ago. With that said, guys, because Johnson & Johnson has been moving downwards pretty steadily since the end of August or so, it might not be a bad idea to just continue watching it and see what it does. There is a chance it could continue to go down, making it even cheaper than it is today, or it could start creeping back up, in which case you might want to pick up a few shares before it gets too expensive and gets out of the buying range. At any rate, guys, this is a good stock to dollar cost average into, or just contribute to little by little, no matter what happens, whether it goes up, whether it goes down. That may actually be the best way to go about it. But let me know what you guys think about Johnson & Johnson in the comments below. I would be curious to hear your thoughts. All right, guys, now moving on to stock number 2, we have Pfizer, ticker symbol PFE. And as you guys can see on the screen, Pfizer is at even more of a discount right now than Johnson & Johnson was, having come down 9.65% just in the last 30 days with a PE ratio that's considerably lower, sitting at 10.41. So Pfizer is looking pretty dang affordable right now, guys. And still looking at the screenshot, if we take a peek at the right-hand side, that 52-week range, we can see it's sitting at just below like half of its 52-week range. So it looks like it's still about $9, almost $10 away from its 52-week high. So there is some upside potential to be found with this company by investing in it right now. And just for full disclosure, guys, I'm not personally invested into Pfizer. I actually used to have it in my portfolio and I sold out of it a while back. I don't remember why. But for the most part, it seems like a pretty good stock to hold, guys. I mean, if we take a look at their dividend stats, it has a forward dividend yield of 3.69%, okay, a payout ratio that's 38.36%, so they could be contributing even more to the dividend if they wanted to, quite a bit more if they wanted to. A 5-year growth rate that's a little bit higher than Johnson & Johnson's, 6.47%, and a dividend growth history that's not too bad, okay, 11 years, that's not too terrible. It's not a dividend king or dividend aristocrat, but anything over 10 years, guys, that seems okay with me. And moving on, guys, taking a look at some of their growth metrics, the same ones that we covered with Johnson & Johnson. For the most part, the revenue growth looks pretty strong with Pfizer, except for that 10 years, it's down 1.69% compounded over the last 10 years, but across 5 years, 3 years, and year over year, it is looking pretty good. In fact, year over year, a revenue growth of almost 60% is pretty wild. I think we can attribute a lot of that, guys, to their vaccine sales. And I think the same is true for that levered free cash flow, what we're seeing there. Year over year, a levered free cash flow growth of over 800%. That's the highest I have ever seen by far. But even across 3 years, 5 years, and 10 years, those numbers are looking pretty good. At any rate, the levered free cash flow is growing, and at least year over year, they have a lot more, 800% growth. That still just blows my mind. But as I said, guys, these huge jumps in revenue and free cash flow in the short term are definitely due to the vaccine sales, which really doesn't speak too much to this company as a long-term investment. But from their second quarter earnings presentation that they put out not too long ago, we can see that they're still growing outside of what they're doing with the vaccine. So if we take a look at the screenshot here, guys, it looks like they grew by 86% in revenue just all across the board, including the vaccine. But excluding vaccine sales, the revenue grew by 10%. So even if they didn't have that substantial boost from their vaccine sales, a lot of their other drugs or a lot of their other products are actually doing pretty well for Pfizer as well, or seeing some success, which contributes to that 10% growth outside of the vaccine, like we just said. So anyway, guys, let's answer the big question. Is Pfizer in buying range? Is this a good stock to buy right now? I do think so. I mean, like I just mentioned, guys, it was just at its 52-week high of like that $51, $52 back at the end of August. And like Johnson & Johnson has been trending down pretty steadily ever since then. Not to mention the PE ratio is getting pretty close to that single digit. What was it? Like 10.41 was the PE ratio. So that's pretty low, which indicates some affordability for Pfizer. Additionally, guys, like we talked about earlier in this video, a lot of stocks have just been coming down lately. The month of September was really rough for a lot of stocks, and it would not be surprising to see that trend continue as we make our way through the rest of October. Really anything can happen, guys. So it may not be too entirely impossible for Pfizer to potentially get under that $40 per share mark. It's really not too far off. What is it right now again? Like $42.02 at the time of this recording. So anything could happen, guys. I mean, if you're kind of on the fence about Pfizer, maybe just continue watching it, see what it does. But it could potentially get below that $40 per share mark, in which case it would definitely be a really good time to pick that up. All right, guys, moving on to the third and final healthcare stock I want to talk about today that I think could be a good buy right now. That's Bristol Myers Squibb, ticker symbol BMY. Now, out of the three stocks we've talked about so far, Bristol Myers Squibb is definitely the most discounted stock of the bunch, which, as you can see, is down 9.85% in the last 30 days, guys. What is going on with these healthcare stocks? And also, the forward PE ratio of this company is the lowest we've seen today, in the single digits, 7.91. And if we look a little bit above the PE ratio at that 52-week range, we could see it's kind of tickling the bottom of the 52-week range right there. It's only a few dollars off, okay, about, what is that, $2.50 off from its 52-week low. And moving on, taking a look at the dividend stats of BMY, it has a forward dividend yield of 3.31, which is not too much lower than Pfizer's, a payout ratio of 26.22%, which is extremely low, okay, a 5-year growth rate of 5.22%, and a dividend growth history of 12 consecutive years, which is just beating Pfizer by 1 year. Honestly, too, guys, moving on to some of the growth metrics, I do think these stats are actually looking more desirable, at least in my opinion, than Pfizer's were. So with Pfizer, year over year, we saw that huge jump in revenue and huge jump in levered free cash flow. That is not entirely the same story here with Bristol Myers Squibb. And even if we look more in the long term, 3 years, 5 years, and 10 years, I do think that those numbers are more favorable than what we saw with Pfizer. So just talking revenue real quick, okay, 10 years, its compounded growth is 8.11%. In the last 5 years, its compounded revenue growth is 20.3%, which is wild. Across 3 years, 27.13%, and then year over year, it's about the same. Okay, then looking at levered free cash flow, guys, year over year, it is down about 40%, which is pretty considerable, but there is an explanation for that, which we'll get to in just a moment. Okay, across 3 years, a levered free cash flow growth of almost 41%, which is wild. 5 years, 26.04%, and then compounded across the last 10 years, the levered free cash flow has grown by 7.74% every year for the last 10 years. So that's pretty solid, I think, and that bodes well for the growth of the dividend, especially seeing how low that payout ratio was, 26.22%. It doesn't look like this dividend is really anywhere close to being in trouble. But anyway, guys, as I just said, there is an explanation for the drop in levered free cash flow year over year. And if we look at their financial statement, we can see that 2020 was an unusually high year for Bristol Myers Squibb as far as free cash flow goes, but still 2021 is considerably higher than what we saw in 2019 and before. So throwing out 2020, overall, the free cash flow seems to be growing and in pretty good shape. And one of the things too, guys, to keep note of with Bristol Myers Squibb is their long-term debt levels. As you guys can see here, the long-term debt jumped up in 2019 and 2020, but it looks like that was due to them making some acquisitions and purchasing Celgene in 2019 and Myocardia in 2020. So when they make these acquisitions, the debt is going to go up, and it does look like they're actively working on paying down that debt, seeing as the current debt levels are now down below where they were in 2019 after the acquisition of Celgene and also Myocardia. All right, and with all of this said, guys, it's looking to me like BMY is the most discounted out of the bunch so far, but that doesn't necessarily mean it's the best long-term investment. And which one is, I think it's going to differ from investor to investor, but I do think one thing that would be helpful for us to look at to help come to a conclusive answer is going to be to look at the historical performance of each of these three stocks. So with that, let's jump over to the screen and take a look. All right, my friends, now what we are looking at here is a really cool tool that I actually have not used in such a long time or shown in my videos in such a long time. This is called the Portfolio Visualizer, and essentially what we can do with this is we can plug in any stocks or any combination of stocks we want to build whatever portfolios we want to and track the historical performance dating back to, I guess the earliest it goes back to is 1985. So what we're going to do with this is talk about how each of the three stocks have performed over the last 10 years or so. So let's set the start year here to 2010, okay? And year 2021, let's include the year to date. And then let's say with each one, there's an initial investment of $1,000, okay? And then we're going to contribute a fixed amount to each of these three stocks. We'll contribute like $100 a month here, change that. Okay, we don't need to rebalance that. Reinvest dividends, yes. Display income, yes, please. We don't need a benchmark or anything like that. And let's set some custom names for each of these portfolios. So portfolio number 1 is going to be called Johnson & Johnson. Portfolio number 2, let's say Pfizer. And then portfolio number 3, you guessed it, BMY. And then let's put each of these in here, guys. So Johnson & Johnson, Pfizer, and BMY. Okay, now let's put 100% of portfolio number 1 into Johnson & Johnson, 100% of portfolio number 2 into Pfizer, and 100% of portfolio number 3 into Bristol Myers Squibb. Okay, that is all looking ship shape, and let's hit analyze portfolios and see how each of these 3 stocks has performed across the last 10 years. All right, so the results are in, guys. Let's scroll down here. So let's first take a look at the final balance. So if you were to invest $1,000 into each of these 3 stocks in 2010, and then from there contributed $100 a month into each one, by the end of that 10 years, including the year to date, Pfizer looks like it would be your best performer, but really not by too much. Johnson & Johnson is here in a close second, and then Bristol Myers Squibb is, in my opinion, considerably farther behind than the other 2. And if we take a look at this this graph here, it'll show the portfolio growth in a way that helps us get a little bit better visualization. So it looks like Bristol Myers Squibb wasn't doing too bad. You know, it was in the lead pretty much all the way up to halfway through 2016, like by a long shot. Look at that, by like $4,000. But then something happened in 2016 and it really took a nosedive, and then since there really seemed to be lacking in performance. But anyway, scrolling back up, one other thing I like to look at with these results is the best and worst years. So based on these right here, it seems like you're going to see the least amount of loss with Johnson & Johnson, considering its worst year was down 5.14% in the last 10 years. But as we can see, that doesn't mean it was the best stock in terms of overall returns. That title goes to Pfizer. All right, guys, now scrolling down, I want to take a look at one more thing, and that is the amount of dividend income across the last 10 years. So if we go to, let's go to 2021, it looks like Pfizer is going to be the best bang for your buck and give you the most dividend income. And the reason we're seeing this number, or all these numbers, lower than in 2020 is because obviously 2021 is not over yet. But if we look to the full year of 2020, Pfizer gave you over $1,000, almost $1,050. Bristol Myers Squibb is in second place, and then Johnson & Johnson is in third place as far as dividend income goes. And this isn't too much of a surprise considering that Pfizer, as we saw, has the highest dividend yield. Bristol Myers Squibb has the second highest dividend yield, and then Johnson & Johnson has the lowest dividend yield. But like we said earlier, there is a little bit of a trade-off with Johnson & Johnson. It seems like you have to give up a higher yield in exchange for that reliability for those 59 years of consecutive dividend growth. So in terms of which one is going to be the best investment out of these 3, it just depends what you're looking for. I mean, across the last 10 years, Pfizer has given you the best overall returns in terms of capital appreciation, and also has given you the most in terms of dividend income. But some people might be more partial to Johnson & Johnson, others might be more partial to Bristol Myers Squibb, which, as we saw, seemed to be the one that is most discounted. So if you're looking to buy the one at the biggest discount, you might want to go with BMY. If you're looking for the one that's going to give you the best returns, which Pfizer's still discounted, you might want to go with Pfizer. But if you're looking for the one with maximum reliability, even if that means a little bit of a lower yield, then maybe Johnson & Johnson. And with all of this said, guys, I'd be curious to hear your thoughts. Out of the 3 stocks that we have talked about today, which one do you guys think is the best investment? Which one would you most likely invest in out of these 3 between J&J, PFE, and BMY? Let me know in the comments below. All right, my friends, now let's move on. Today is Sunday, which you guys know what that means. It is time for a weekly dividend portfolio update. So let's go over here to my dividend portfolio tracking spreadsheet where you guys can see pretty much all of my important portfolio stats right here. As it currently stands, my portfolio's market value is $27,571.21, and my total gain in this portfolio is 4.46% with an annual dividend income of $1,272.76. Now, comparing this to my last dividend portfolio update, which I put out about a week and a half ago, last time we did one of these, my portfolio was considerably lower. As you guys can see, the market value at that time was $27,090, which is about $500 less than where it's currently at. And my total gain is about 1.4% lower than it is now. So I have seen a little bit more growth in this portfolio since the last update. And my annual dividend income has grown a little bit as well by about $4. Nothing too crazy. And I'll tell you guys what, it is very bittersweet to see this number going back up, this total gain number going back up. On one hand, it's good because I like that my stocks are performing well, but it also makes stocks more expensive, which means I have to contribute more dollars to add the same amount of dividend income. So it is bad in that regard. So like I said, overall, it's pretty bittersweet. Anyway, let's jump over to this portfolio summary page. If you guys have been keeping up with my portfolio and some of the goals I have with it, you'll know that I just added Lockheed Martin not too long ago to my portfolio. And one of my goals switching over to this diversification page here is to make this company, probably when it's all said and done, about probably 3+%, 3.5%. It's almost 1% right now with this week's contribution to this stock. And I want to get it so my industrial allocation in my portfolio is up to my target goal of 11%. And I have about 3.5% to go. So I guess when it's all said and done, actually just doing the math, Lockheed Martin will be about, what is that, 4.5% of my total portfolio, which is a percentage I am comfortable with, guys. I like this stock. I think it's at a pretty good discount right now, so I'm happy to be buying into it. And scrolling over here, guys, so you can see these two allocations here. My technology allocation is considerably lower than my target goal for this one. I want to get my technology in my portfolio to 5%. And the only tech stock I have so far is Intel right up here, which is currently sitting at about 3% of my portfolio. And I'm undecided on whether or not I'm going to make this the whole 5% to reach that target allocation, or if I'm going to add one more tech stock to my portfolio. I feel like I've been adding a good handful of stocks to my portfolio lately, which it wouldn't be the end of the world for me to continue adding more and become more diversified. But then again, I like the idea of having bigger positions in the stocks I already own and having more dividend income with the stocks that are already in my portfolio. I don't know if there is a right answer here. It just depends on personal preference. But when it's all said and done, there is actually one more stock I wouldn't mind adding to this portfolio in the tech sector, and that is Microsoft. You guys have heard me talk about that before, and you will actually hear me talk about it in the next video, so stay tuned for that. But I would not mind adding Microsoft to this portfolio if it comes within buying range and becomes more discounted. It's currently looking pretty expensive. But in the meantime, guys, I can continue contributing a little bit to Intel and also continue building out my Lockheed Martin position. And then one more thing I'm kind of chewing on, I'd have to switch around my target allocations, but I am kind of looking at adding Target to my portfolio. Between that one and Microsoft, those are probably the big two I'm looking at adding to my portfolio, if any, right now. But then again, I would have to mess around with these target allocations here and make a little bit more room for that. And going back to this portfolio summary page, I want to talk to you guys about what I bought this week. I just bought a little bit of Lockheed Martin. I bought about a third of a share with a $125 contribution. And then going into next week, guys, I'm going to be doing the exact same thing. I'm going to contribute $125 to Lockheed Martin, and that should get me just over one full share, which is pretty cool. I think this company, let's see here, if we scroll over, pays, okay, $11.20 every year for the dividends. So that'll be a good little dividend income boost right there. It should get me to about $1,275 in annual dividend income, which is pretty cool. But anyway, guys, that's about all I have going on in this portfolio right now, so let's move on. All right, my friends, and that pretty much wraps it up for this video. I think this is a relatively longer one, so thank you for sticking around till the end if you are still here with me. Before you click off to the next one, do me a favor, leave me a comment below. Let me know, out of the 3 healthcare stocks we talked about today, which one you guys would most likely invest in. Like I said, I'd be very curious to hear your thoughts on the subject. And if you have not done so already, please don't forget to leave a thumbs up, go hit that like button on this video. And also, if you enjoyed watching this one and want to see more content from me, go ahead and hit that subscribe button as well. But that's about all I got for you guys. So thank you once again so much for watching. I really appreciate it. I hope you guys have a great day, and I will see you in the next one.